Good morning. Thank you for taking the time to meet with us today. It is a pleasure to be here at corporate headquarters in the presence of the board, especially the CEO, Mr. Alamo. As the president of the PrintSpin Marketing Division, Melina Miller, I'm honored to introduce you to the vice presidents, Paola Leon, Alexandra Reyes, and Patrick Dorlin. We are here today to provide an executive summary of the marketing plan for year 2 that we have constructed utilizing the data collected from year 1. Let's begin with the past year in review. Q1 was dedicated to the initial stages of assessing the market. In Q2, we developed our first 5 brands and began opening our first 2 stores. Q3 was our first real test of performance, from which we learned a lot. Of the 8 companies in the market, we came in at 2nd in market performance, 3rd in marketing effectiveness, and 4th in total overall performance. We were pleased to see a positive net profit, but wished to aim higher. Q4 demonstrated that we needed to increase our ability to adapt based on results. We remained in 3rd place for marketing effectiveness, but went down by 1 in the rankings in both market performance and total performance. However, we saw improvement in our consumers' average brand judgment. Our market share went down despite this, which revealed that we needed to expand and be more aggressive in our approaches. Still, we were pleased to see our gross profit more than double even before expansion. Despite an increase in operating expenses and the investment in setting up 4 new stores, our net profit still exceeded that of Q3. It is worth noting that at this point, our cumulative net profit across all quarters ended as a positive, despite it being a testing year. Providing an assessment of the current market analysis is the Vice President of Brand Management and Internet Marketing, Paola.
Here are our brands as of the end of Q4 for our top segments: work, speed, recreation, and mountain. Our goal was to optimize one brand offering for each target segment, though we excluded the youth segment due to its relatively low demand. We will begin offering a youth bike as a Q5, though we will be cautious with the expenses incurred in advertising it due to the low demand. Overall, the customers in our segments are satisfied with our brands. Currently, we have feedback from our European market pre-expansion that our customers are highly satisfied with our pricing strategies as well as our ad copy. This indicates we are meeting their needs, especially in our top priority segment, recreation. With a score of 100 across the board for all of our segments in price judgment, we are confident that customers will be willing to pay more for the features we have selected for the bikes. Our strongest competition consists of Relampago Cycles and Traily. Relampago Cycles are the strongest in market performance and marketing effectiveness and have open stores in all the available cities for one region, Europe. This led us to strategize decisions for market expansion. Our next top competitor is Traily. Traily has proven to be extremely successful in financial performance and creation of wealth, which PrintSpin could learn from. However, Traily has a weakness, which is its decision-making towards investing in the future. As we analyze them closely in the upcoming quarters, we will better understand how they improve their company's ratings and how we can modify that to PrintSpin's advantage. As PrintSpin begins to enter new markets and modify brands per segment, it is essential to reflect on its current strengths, weaknesses, opportunities, and threats. PrintSpin's strengths are that it successfully has met the needs of customers in its top segments, has learned to utilize market research efficiently, and has a high percentage of market share. Weaknesses include PrintSpin's ability to drive demand. Since we were cautious in the beginning to expand, we had a conservative approach which did not allow us to increase our demand to its highest potential. Opportunities are markets in available cities in which we have not yet opened stores. Additionally, research and development holds promise in appealing to our target segments and providing a tailored experience to bike riders. The threats we face are falling behind our competitors and not performing as anticipated in the unknown markets, since there is currently no competition in some cities that we can learn from, as of the end of Q4. Laying out our goals and strategies for year 2 is the Vice President of Advertising and Business Analytics, Patrick.
These goals are aimed towards the future profitability and sustainability of the company. We are focusing on increasing profits and generating new money to elevate and further promote the growth and success of the PrintSpin brand. Based on our projections, we plan to increase operating profit by 225% from Q4 to Q5, by an additional 250% from Q5 to Q6, From there, we expect to increase by a moderate amount per quarter after that. To help achieve this, we plan to increase demand by 210% from Q4 to Q5, by 150% from Q5 to Q6, by 10% from Q6 to Q7, and by 5% from Q7 to Q8. This should provide us with an increase in market share. Based on these projections, we plan on showing a 400% ROI by the end of the year 2 in order to demonstrate the division's profitability. In order to achieve our goals, we plan to make use of various strategies to meet the specific needs of our company. Firstly, we plan to increase the total number of stores the company currently has, opening in North America, Europe, the Middle East, and the Asia Pacific region. This provides us a strong presence in the most profitable markets and regions based on our market research. This increase in stores would go to increase the overall demand for our brands. In conjunction with this, we're going to increase and cater our salesperson distribution depending on the specific market, taking into account aspects such as demand by brand and demand by segment. This increase in specialization of salespeople will go to supplement and improve our demand generation in new and existing stores. In addition to simply raising demand through expansion, we will get ahead of our competitors through R&D. With the new components gained through research, such as better carbon fiber and more comfortable tires, we will be able to create higher quality bikes that more accurately fit the needs of our target consumers. This, in tandem with new advertising for these new features, will work to draw consumers from our competition that are looking for something that better fits their needs. To demonstrate how our strategies will play out in the future, here's our Vice President of Finance and Sales Management, Alex.
In order to increase our competitive advantage, we plan to cater to each segment. We will also invest in more salespeople to account for the additional stores that we will open. We foresee the need to make ad modifications to go along with our evolving new brands. Lastly, we want to have enough spare funds to respond to unexpected events that could either hinder the company or improve future quarters. With all this in mind, here are our year 2 projections. With our 6 existing stores, we plan to see about 6,500 sales in Q1. Though we project a significant increase in gross profit, we will also be making significant investments in opening 4 new stores and starting strong in R&D for new brands. Therefore, the trade-off for investing in the future is that we will see a negative net profit this quarter. In Q2, we will utilize the R&D that has been completed to create an additional 5 brands, 1 per segment, that will be geared toward the less price-sensitive micro segment for each category. We will also staff our newly opened stores, spreading our operation over 10 cities. As such, we expect to see an increase in sales. Along with these sales, our gross profit should nearly triple, and even though there will still be significant operating and R&D expenses, our net profit should near $6 million. Q3 will be dedicated to further refining our high-end brands. As we further refine our advertising as well, we expect another moderate increase in sales. Our gross profit should be about $11 million, and after expenses, our net profit should be over $8 million. By Q4, we should be settled comfortably into our place in the market. As we make more of a name for ourselves, there should be an increase in sales. Gross profit and net profit should also increase marginally from Q3. As this 2-year testing period ends, we expect to have created at least a 400% return on the $4 million investment we received. Here is a more thorough breakdown of our profitability projection quarter by quarter. We will, of course, provide this to you for review. We hope that this demonstrates why our division was a valuable investment with much future potential.
Thank you for taking the time to meet with us, and we can't wait for you to see the results of year 2.